Greetings and salutations, everyone. Let me be your guide through the internet to this portfolio overview. So with a little bit of that ham out of the way, let's talk about what I think is going to be one of my more in-depth portfolio overviews. There's certainly been a lot of activity in my portfolio over the past little while. I've recently sold my home, got out of home ownership, took that equity, plowed it right into a cover call ETF. So let's talk about what I've bought, talk about a little bit how I've been building wealth through cover call ETFs. Maybe that sounds like a bit of an oxymoron, but it is possible. Just like it is with like any kind of money making idea. If you got the interest and you got the intent, the ambition is there, you will find ways. Your mind will cut through the noise and find all sorts of ways that to hone in on a strategy that works for you, especially if you got a passion for it. That's some of these ingredients, they're often overlooked, but they certainly go a long way. We'll also talk about dividends on a month-to-month basis, how they've grown over time, and performance data, my portfolio versus other indexes like the S&P 500, the NASDAQ 100, the TSX 60. So let's get into the building wealth aspect of it. Just so for the newer people out there, just so you understand, I started investing when I was on the cusp of turning 31. I'm 35 now. I started with $45,000, which I had saved up over a 3-year period, put it into a low savings account, a 0.01% savings account. I had no ambition, no intent, no interest in any kind of entrepreneurial endeavors, stock market, seeing squiggly red lines on a Chiron on a TV was like no interest whatsoever. I just thought that was unsafe. I thought I needed a degree, thought I needed basically brains I figured I didn't have. But that was just it was just me being naive, a lack of confidence in myself, and just an unwillingness to explore the possibilities. Having been on the other side of that now and getting over that learning curve, it's the complete opposite, where the belief is now this can be taught, anybody can do it. It doesn't matter your job, guys. I'm a plumber. So it doesn't matter. You could be a nurse, a janitor, an engineer, a trash man, whatever. Doesn't matter. It can be done as long as you're willing to learn. You're watching videos, you're reading, you're listening to podcasts, whatever. Just take it all in and let it help form and shape your opinions around finance. Anyway, let's get into where this journey starts, which is here at $110,000 in January of 2023. So I had grown that initial size of $45,000 to $110,000 by this point. This is when I joined Wealthica. Now, from January of 2023, I made my first, I should say I got to the $150,000 mark in November. So that would be, 11 months later. And then from November, I want to say it was July of 2024, I achieved my next, 50 grand. So anyway, the timeline started to shrink. So keep in mind, July of 2024, when did I hit my next milestone? Don't quite hit 250, but it was, I guess you could say it was probably another 7 months later or so. And then the Trump tariff stuff and chaos, Liberation Day, that kind of ensued. And then you see here a big, massive jump. That was a big deposit of around $75,000. And then we get a little bit of growth here at the end of that. So anyway, in the journey upward, this is not simply just the performance. There's so much more that goes into this line going and trending the way up. Part of it is, yes, just the natural performance, the capital appreciation of the funds. But Jordan, I thought cover calls capped upside. Yes, but certain funds are built differently, and other fund managers put their own spin on these cover call funds. So it just kind of depends. They're just not all built the same. So that's something that you'll come to realize that with more time that you put into learning about these funds. Some are much more growth oriented just because they have more momentum driven assets in as their underlying to help it give it rocket fuel. But also, too, it's just how much are you contributing on a consistent basis? How much are you reinvesting? So that's all me. It's just monthly doing $1,000 a month of contributions. There's been wild times in my checking account where like we were down to like $20 and we still managed to stay the course, $1,000 a month. I found out that I was much more consistent once I pegged a number. So instead of being, say, 10% or 5% as a way to save and contribute, I picked $1,000 because that was a difficult number, and I just stuck with that. And it was really hard at first. It was still even hard well into that, but I've probably done that for the last couple of years, just $1,000 a month. I can't do more than that at the moment. So private school is expensive. And then along the way, right, there's some capital gains that I've made in my TFSA, because that's basically been my only account for this whole time. So small moves there to make the portfolio more lean, more mean. And then at the same time, anytime I came into like a little bit of money, like a tax refund, I just plow that back into investing into these cover call ETFs. So and especially if it made sense. I mean, I'm not absolutely destroying myself to contribute. Especially, I got 3 kids, right? I got to prioritize events and going away and all that good stuff with them. Now that we're 2.5 years later from that initial $110,000, and this portfolio is now 2.5x since then. So let's move into the kinds of ETFs that I have as far as cover calls are concerned. Now I'm on Blossom, the social investing app, if you haven't heard of it. They have an app and a desktop version as well. And it's great to track your portfolio. You can see what people are talking about in a thread, and you can participate and all that good stuff. So I like that. I like to read all the different ideas that people are throwing out there, and it's great that way. And then you get the portfolio tracking tools in the pro version. There's a referral link in the description below if you want to use that. Get $5. It's small, but to track your portfolio and get those deep insights that you're about to see, definitely worth the while. So let's start with the first fund that I decided to pick up, HHIS. Now, not a penny of my sold house money went to HHIS. I actually swapped out HYLD.U for HHIS. And it was it was $92,000 or anyway, something like that. Maybe just under $92,000 that I bought it with. And in the 1 week that I've owned it, boy, it's probably good timing there. I mean, it's nice to see, but I'm in it for the cash flow that it produces. So this is a bonus. This thing is going to be rocket fuel on steroids. Think of going at light speed in the Millennium Falcon. That's exactly what you're going to get out of HHIS. It is the most momentum-driven, diversified fund out there. I mean, it's right in the name, diversified. And I just mean holdings. Again, you get a lot of the tech American stuff in there. So I expect this to be quite the driver for the main portfolio overall for growth. But again, what's rocket fuel in the good times? In the not so great times, it's going to be quite the anchor on the portfolio. But there's some other things to balance it out. So that's in my wife's spousal RSP, which is a great account, especially if you're a high income earner. I'm in the 38 to 40% range. My wife doesn't earn an income. So the beauty of this fund, and the reason why I think having HHIS in here, is it just fits so many of my concerns, my goals. My wife is a dual citizen, so if I was to basically open a TFSA, a non-registered account for her. It just triggers so many just complexities I just don't want to deal with. So what's probably just better is just keep HHIS in here. That way it's tax treaty sheltered. I mean, who knows for how much longer? I mean, the triple B, big beautiful bill, and section 8899. Who knows with all that? But I think overall that most of that stuff should stand, and I think I'll be okay just keeping it there. And again, the other great thing is if you contribute to it, I'm the high income earner, I get the tax write-off. But if I stop contributing to it for 3 years, and say we start withdrawing from it, that like attribution rules won't kick in, and so any money coming out would I would say it would render under her taxes. And by the way, here in Canada, the first $15,000 federally is tax-free. The first, I'm out here in BC, so first $12,000 is tax-free. So we get a bit of a buffer of tax-free money if we were to withdraw. And I mean, it's tax-free anyway, as long as I reinvest and just keep it in that account. So it just fits the box of and checks it off of many things that I've been trying to work around and figuring how I'd put HHIS into this portfolio. The irony is I probably made a video like many months ago talking about dropping 100 grand into HHIS. I pretty much did that. And at the time I was talking about how I would do it in this account. Since in that period of time, I probably circled around and considered putting it into a non-registered account. Maybe what I was thinking of doing a TFSA for my wife because of certain rules I read about that maybe it's actually okay and it won't count as a foreign trust and all this. Anyway, I circled right back around to where I started, which is having HHIS in a spousal account. And this is the best place for it. It's going to be a potential growth driver naturally, but also an income driver as well. And I'll probably, who knows? I mean, if this fund rocketed up, 20% in 2 weeks or something, I'd probably sell it off, take the capital gains, wait for it to come back down to earth, buy back in again at some point. It's just, that's the nature of a fund of it, the kind of fund it is. If it just rockets up way too quickly, I think it might be, at least for me, take the capital gains, wait for it to come back. But for me, it's a long-term hold. If I doubled my money with it, maybe I get to 200 grand with it. Maybe I would consider selling it off and just getting back into kind of more the USCL and the HYLD type stuff, BMAX, like the all-in-one type stuff. The rest of the portfolio, the next batch would be my TFSA. So QQQY, HYLD, QQCL, USCL. Let's skip over bank and UTS and BMAX and HDIV. So my TFSA is really a bunch of all-in-ones. It's American focused. Basically, it's the strategy that invests in. It's got the most multi-levels of diversification from different fund managers and strategies, asset classes. The different sectors inside of it is just all over the place. But that's how I wanted it. It's got a couple of more, I want to say defensive, but the reality is, like, BMAX is certainly, it certainly holds it on. I can't even scroll down just to see what it's like. But let's just move it up just so you guys can see BMAX. I say that, but I gotta it. Honestly, it's always near the top when it comes to just the price appreciation. So I think of BMAX and HDIV as more kind of defensive all-in-ones, but I think the reality is, like, BMAX just, it is such a fascinating fund when it comes to its offensiveness and how it maintains it's capital appreciation even when times are not so great. So, I mean, BMAX, honestly, it's often overlooked because it's got one of the lower yields out there. I say lower, but I mean lower for the double-digit yielders out there, right? It's typically at around 10%, but certainly not one to overlook. The folks over at Brompton, they do got something special with BMAX, but it's a shame that the community doesn't appreciate BMAX as much as I think it should. It's a great strategy. So that's TFSA. My personal RSP is just one fund, EQCL, more globally focused. So you got emerging markets, you got developed markets, you got Canada, and then you got all the major indexes in the States in there. So I'm just going to keep that as a global fund. It's basically, your XEQT, something like that, as far as just anyway, it's just all equities. There's no fixed income in there whatsoever. You get 25% leverage in there as well. Pretty much everything here is 25% leverage minus QQQY. Okay, so what did I spend my 75 grand on? It was these three right here in a non-registered account. So this account, again, going full circle, I've talked about a non-registered account, maybe in my wife's name. I ended up just doing it in my name, just for the high yield and the tax implications for it. So UTS, ENCL, and bank, focusing on the major three sectors here in Canada, which are financials, energy, and the utilities. I mean, maybe you could throw in industrials in there as well, but a couple of popular funds with bank and UTS by Evolve. And then, of course, you got ENCL by Global X for that Canadian oil exposure. So I'll probably end up with some combination, if you're familiar with how ETF taxes are broken down, between ROC, eligible dividends, capital gains. Anyway, some mix of that with those three. And really, I want these three in there to be kind of the bigger stabilizers in the portfolio. EQCL is going to do that. These three funds are going to do that. Again, in my TFSA, I got plenty of tech-focused, tech-heavier, growth-oriented stuff, even with that cover call writing. And then, of course, HHIS, the steroids of just potential growth. But so far, it's working out. I mean, in 1 week, I'm expecting to get close to about $5,000 in dividends for July. And this pretty much takes the cake in 1 week. Again, it's not realized, but it is just kind of fun to watch the capital appreciation over time. Let's go into some of the insights that we would probably get with Blossom here. Let's just check out my performance versus the S&P 500. Now, this is price comparisons, right? So you got me in green. And then you got the S&P 500 in the purple color there. So it's up about almost 5%. So if you go over here to total return, you'll see that I'm up with price appreciation and dividends included. I'm actually above the S&P 500 at 6.65%. But am I above the NASDAQ? So NASDAQ is up year to date, 7.21%. So no, I'm not, but that is pretty incredible that this cover call ETF portfolio total returns can actually keep up with something as magnetizing in its growth like the NASDAQ 100. And we could even compare it against the TSX. And how's that going? TSX has actually done really well this year. It's actually held up surprisingly well. But typically, if the States and the tech growth stuff isn't doing so good, it's like having a little bit more Canadian exposure can certainly, to me, it helps it kind of offset that. So you're not just plunging down into oblivion with all the tech that might be in your portfolio, right? Having some balance in there is probably not a bad idea. But anyway, so not beating the TSX, but hey, close behind, 3/4 points behind. let's actually look at allocation. As far as the average sectors held by the entire community on Blossom, with tech, basically the average person holds about 20% tech. I'm much heavier in 31. Now, as an income investor, well, I got to be careful about saying you have to, you should. For me, to sort of make up for the potential capping of upside that you're going to get with cover call ETFs, is to lean a little bit heavier into the more growth oriented sectors. So that is going to be the sector that I believe in. We're still going to see plenty of productivity, lots of growth out of cover call ETFs. I think can still naturally capture that upswing, not just through the distributions alone. So for me, this was actually probably at 40% at one point. So I've with buying ENCL and Utes and Bank have brought that sort of back down to earth. And this is a range I'm perfectly happy with. Financials at 17, again, happy with that number here in Canada. We're very financially focused. That's our top sector. Energies, utilities, no surprise there with the kind of weightings that I have. Probably a bit surprising that I don't have, say, healthcare any a little bit higher, since a lot of these all-in ones focus a ton on tech, but also healthcare as well, if it's much more American focused. Let's actually talk about maybe some of the dividends. What did I make in 2022? I made $5,275. Actually, 2021. I definitely made more than that, but anyway. 2023, not just doubled, really almost tripled, and made $14,757. 2024, another big jump to $23,456. And then so far in 2025, I'm up to $15,204. But keep in mind, going forward for the rest of the year, the last 6 months of the year, I'll probably make another, call it $30,000, somewhere in there, probably a little bit more. So I'll probably end the year in the $45,000 to $50,000 range. So that'll be a complete 100% cash flow jump in distributions from 2024 to 2025. And then 2026 will come along. And now, I don't think I'll double, but we're talking 10, 20, 30% increases year over year, right? From here to there. I mean, that's like, math isn't that great, but what is that? 80%? Something like that. 80% increase. I'll more than double that in 2025. It's exciting to see this cash flow grow, reinvest it, and let it work towards that total return performance. We're always reinvesting when it comes to that. Now, if I click on here, what have I made so far this year? I started the year at $2,301. Another big jump again, 2,357, 2,409, 2,546, 2,751, and then in June, 2,837. So the month-over-month increase is also so much more rewarding than just simple cash appreciation, because this really does help think about replacing paychecks and thinking about grabbing power back from the company you work for. Maybe you like working for them. I like the company I work for, but to me, it's just a way of effectively just protecting myself from any kind of surprises that might come my way, like a layoff or something of that nature. So having the confidence in these cover call ETFs to get me to that kind of confidence level, it goes hands down. So important. I would say projected income. I know the forecast. The forecast isn't correct, but going forward over the next year, if I was to just take the income right now, it says 40 grand. It's more like 60. I'm basically at a point with my portfolio. If we go back to just the overview here, I'm basically at a portfolio size, and with some of the other costs of my life, I double my square footage. I live in a townhouse, rental, so that's a lot more expensive. That $1,000 I was contributing to my portfolio now goes towards that. But the offset is I take that equity in my condo, plug it into the cover call ETF portfolio here. And now I got to admit, I'm kind of at a portfolio size that can generate, again, that almost $5,000 a month. It can be a self-sustaining kind of portfolio, and just reinvest, keep that growth going. And the only time I'll really, I think, contribute to this is, I mean, never say never, but it'll just be for lump sum occasions, I suspect, or if there's other ways in which that I can, just leverage the channel to offer other services. Maybe there's, a gigantic boost in, people using the ALLSTAR tracker, which you can also see my portfolio over there as well if you don't want to join Blossom. So this has all my positions, all my yields versus market yields. There's, again, great info in here. A lot of live data when it comes to performances and even yields. These all change, by the way, on a minute by minute basis on when the trading day is live. So lots of live information. It's just the static information that I got to update on a monthly basis. But anyway, you can pick that up in the description below if you want more insights into 300 plus funds. A lot of great data there. So with a portfolio this size, again, it's going to be kind of a self-fulfilling prophecy at this point. I don't feel like if I bust myself at work with overtime just to contribute another $1,000, it's impactful, but it's just the time factor that is not as crucial anymore. I've been in this contribution mode for so long that I finally can maybe just step back a little bit. As other opportunities come up, I'll probably just lump sum invest at random opportunities, especially once January 1st comes along. We got more space for our TFSA, more space for our RSPs. Eventually, once I'm eligible for the FHSA, I'll probably invest in that too, just for the tax write-off. And eventually, instead of using that for a home, I mean, who knows? Maybe I would use it for a home, but then just put it towards the retirement account with that EQCL in there. So I must say, for everything that I have in here, I really wrestled with it probably for about 5 weeks as well. It wasn't as clear to me just exactly what funds, how to use HHIS. Do I want to do this account for my wife, or do I do, there was a lot of questions going through my head. I did some model portfolios, and it wasn't until I actually wrote it down and actually figured out what funds, what would make the most sense for taxes and, for more growth in one spot to be, and for other spots to be more defensive. It wasn't until then where I locked into what I have now, where I decided this is the portfolio. I know it. This is it. And I'm very happy with what I have now. There really isn't any more need for any sort of streamlining, any additions. I have everything I need right now in here. And as other funds come online, maybe they're better. But, I'm going to keep a weather eye out for those funds. I mean, HHIS, I kept an eye out for that. I didn't plow into that right away. I definitely waited many months before I was confident that this is the fund that I thought it was going to be. It's proving to be. Hopefully it continues to prove its point. And hopefully we keep seeing results like this, especially in these times where there's a little bit of growth happening. In this week of recording, there's been a lot of good news, except on the day of recording, right? Trump wants to throw a slap in trade talks and slap more tariffs on Canada. So that naturally sent the S&P into a little bit of a tailspin, but been there, done that here in 2025 with the tariff stuff. It's becoming a little bit just a blip on the radar. Keep reinvesting, keep learning, stay interested or develop the interest if you don't have it, because I'm telling you, I was I'm sure a good case study for someone who went from don't care, don't know, to what this is today. And the reality is anybody can do this stuff, but it does take time. you'll gain a kind of insight and maturity that you probably never knew you had. I certainly didn't, especially when it comes to financial maturity. So with all that being said, hopefully you all enjoyed this overview of my portfolio, the whys, the hows. There's no doubt there's so much more to talk about. But until we talk next time, hit all the buttons of like and subscribe variety. I'll see you all in the next video.